What's going on, everybody? My name is Ryan. I'm a CPA, and today I'm going to be talking about S corporations and what you should know about them, because everybody and their moms talks about getting an S corp when you form a business. But first, I would love it if you would please subscribe to my channel if you're new here, and also give this video a like if you think you're going to find it helpful, or maybe wait until the end. That's fine too, but preemptively is good too. Also, if you have any questions or comments, leave them below in the comment section and I'll do my best to get back to you. Alright, so the first important thing to know about forming an S Corp is that a lot of people do it very incorrectly. So an S Corporation is not actually a legally recognized entity. It's actually an election you make to file taxes with the IRS. So a legally recognized entity is like a corporation, a partnership, or an LLC, or a sole proprietor. Okay, but if you form a corporation with your Secretary of State and then you register for an EIN with the IRS, you are not an S Corp. The IRS will be expecting a C corporation tax return. That's why there's another step to elect to file taxes as an S Corp, and that's filing Form 2553. So a lot of people, a lot of new business owners make that mistake. They get with the Secretary of State, they file their business there, and then they get an EIN letter from the IRS, and then they think that they are an S Corp when really they are not. So do please be careful about that, and definitely talk to an attorney or a tax professional when you're trying to form your business as an S Corp. Any kind of business, LLC, partnership, make sure you talk to an attorney and a tax professional. The other thing that you must know about forming an S corporation is that you, as the active owner, you're required to take a reasonable salary. Now, if you're an owner of an LLC, you're not required to take a salary. In fact, you're not actually legally able to take a salary as a member of an LLC. Same if you are a partner of a partnership, you're not legally able to take a salary. But if you're an owner of a corporation, S or C Corp, then you can take a salary. And if you're an owner of an S corporation, then you must take a reasonable salary. Now, I'm not going to get into what's reasonable here because there's too much liability there. So, because it all depends on your position, your responsibilities, your experience, your location in the markets, how much money your business makes, all that stuff to come down to a reasonable salary. I think a good rule of thumb is you don't want to be paying yourself $3,000 a year in salary. That is not reasonable by any means. So definitely get with a tax professional in your area or someone that you work with closely to determine what a reasonable salary is for yourself. Distributions are the next thing. So a popular thing for S Corps that people talk about are paying yourself distributions, because then you don't have to pay self-employment taxes on those distributions. And while that's true, there's a lot more that goes into distributions that you should be aware of. So distributions are basically payments that you make to yourself on top of your salary, on top of your reasonable salary. It's basically a movement of equity from your business to you personally. And it sounds simple, right? You can either just write yourself a check or initiate a bank transfer between your business and yourself, and you can call it good. However, if you distribute too much money from your S corporation, then you may be subject to additional taxes, capital gains taxes. And that's going to be a problem for a lot of people who are not aware of this. So if you are an owner of an S Corp, and let's say you have a basis, a shareholder basis of $20,000, which is basically your equity in the company, $20,000, but you distributed $30,000 in that same year, then you have an excess distribution of $10,000. And that excess is subject to capital gains. That $10,000, now you have to report it on your personal taxes on your Schedule D as excess distributions, and it's going to be taxed with capital gains. This usually happens when the most common scenario is when businesses take out loans, they take out a loan, and then they subsequently distribute that loan money to themselves personally. Because taking out a loan sometimes may not increase your basis. It actually sometimes might not even do anything with your basis. And then you subsequently distribute that money to yourself, which will create a taxable event with that distribution. Another problem is if companies constantly report net losses because losses decrease your shareholders' basis. So if companies frequently or commonly report net losses so that shareholders have no basis, then they take out distributions from their company, that's going to result in a capital gain event also. So a lot more to distributions for S Corps than just, this take out money whenever you need it. Another thing about distributions is that if you own a S corporation with one or more shareholders, your distributions have to be taken on a pro rata basis. So for example, if you have a corporation where you are 50-50 owner with one other person, you must take equal distributions as each other. Because unlike an LLC, S Corps don't have the flexibility of determining, one shareholder can take more distributions than the other. No, with a corporation, you have to take equal distributions if you're 50-50, or it's based on your pro rata ownership percentage. So if one person owns 30% of the company, the other owns 70%, then they have to take that exact same share of distributions each year. Next thing I don't see as often, but just wanted to point out that people sometimes put rental property in S Corps, and I just really don't advise people to do that because property held in an S corporation don't get that step up in basis if the shareholder passes away or dies, which is a huge tax advantage for real estate. When you own it personally or in an LLC or partnership, you don't get that same benefit as an S corporation. And the last thing I'm going to mention that it should be so simple is the tax return of the corporation is actually due 1 month before your personal taxes are due. So if your personal taxes are due April 15th, the corporation's return is actually due March 15th. And I guess the more general way to say this is it's your corporation's return is due 2 months and 15 days after the end of the fiscal year of the corporation, whereas your personal return is due obviously 3 months and 15 days. So people don't realize when they form a new business, a new S corporation, that those tax returns are due a month before their personal return. All right, so that's all I got for today. Thanks for joining me. Again, my name is Ryan, and if you found this video helpful, please give the video a like. And if you're new here, please consider subscribing to my channel. I'd really appreciate that. And that's all I got. Take care for now and stay safe.
I'm in the mood for a switch up. I hit the function, hit the rose till I hiccup. I hit the stage and leave with money that's a sticker. She picture perfect, so I told him I'm a flicker. Bill, I'm in the mood for a change up. I leave the city and return with my change up.